discuss this, I have with me Santosh Rao, who's the head of research and partner, Manhattan Venture Partners. Welcome to ET Now, Rashar. Well, my first question is, the US Treasury yield has ticked up 5%, earlier this week, and it is still hovering around those multi-year highs. What does that mean for the Indian markets?
For the Indian markets, I'm sure whatever happens here does flow over there as well. But let me just start with the US markets. I think this is a very important level, the 5% level. To breach that will have major consequences because 10-year, as you know, is the benchmark for many things. It's for home mortgages, car loans to some extent, and many other things are pegged to the 10-year rate. So I think that has a ripple effect on the economy. It's going to slow things down. Already, we're seeing credit tightening. So that's a big issue. And the 2 and 10-year yields in uninverting is also has a history behind it. You get a recession 3 to 6 months after if it starts uninverting more and more. It's kind of getting there, but it's not there yet. So I think that's what we're seeing at. I think it's a major issue. We don't want it to go up too much. Plus, also, as you see, people will go into bonds more than stocks. They can get a risk-free 5%, 5.5% return. So why go into stocks? So all those things play into the market. So net, high 10-year yield has major consequences. International, I'm sure that has an impact because if the rates go up, the dollar is going to go up, and that's going to have an impact on the emerging markets, the emerging currencies. So I think that has a ripple effect on that side. So net, not good. We don't want rates going up too much.
Now, interestingly, you mentioned that, it's an alarm bell if the rates tick up, over the 5% mark. Do you think that this 5% mark is also likely to sustain? What is your sense there? And if yes, then do we see foreign money then flowing out of India? We've already started seeing the sell-off in the Indian markets as well.
Yes, very likely. And 5% is just a red line, and it can definitely go up. There are some estimates that it can go as high as 6% if the inflation stays sticky, and we all have all these geopolitical and all the labor strife and so many other things playing into this whole underlying fundamentals. So I think all that is not good. So we can easily see going up higher. But the Fed has said they're going to be higher for longer. But then they may have one increase or maybe not because they feel that these rates are doing the job for them. So that will be a good sign. Plus, we're heading into a political election year next year. So I'm sure there will be some pressure there as well to not really go up. And the interest payments on the debt payments are going up. So all those things are kind of out there. The big issue is the Fed is focused on this 2% inflation target. Let's see how much he can stick to it. Is he going to be comfortable with 3%? We're going to have PCE data, I think, tomorrow or day after. Let's wait and see where that comes. So things like that. So inflation is sticky, needs to come down. He's hell-bent on keeping that down. He's going to keep rates up there till it happens. But we want to make sure that it doesn't break things in the economy. And that's the big risk at this point.
Right. And Mr. Rao, a few months ago, most people expected that the US government deficit would keep going down with the growth slowing. But it was 3.9% last year, and it's actually going up with the growth slowing down. And that is quite alarming for bond investors. US federal government, ended this fiscal year this September with a fiscal deficit of almost $1.7 trillion. Is this an alarm bell for all the bond investors then?
Well, we've known this, and I think the federal deficits have not been an issue. They always felt like they can be managed, but I think slowly things are beginning to get noticed because the interest payments are going up, and that's almost as much as the Medicare and all the fixed payments that the government has. So at this rate, it's just going to keep going up. But they feel that can be managed, the rates at point, the interest payments. But overall, there's still, I think the biggest issue is the spending. And the government continues to spend. We have all these programs. We're raising more money to fund the Israeli war, to fund the Ukrainian war. So all those things are going on. Then we have this major tussle going on in the Congress where they can't elect a leader and pass laws. So that's slowing things down as well. So I don't know where we're going. There are a lot of dark clouds hovering, let me put it that way, out there. If things are not managed properly, they can get out of hand. They can still be managed. if the rates are held steady, inflation keeps coming down, and we start getting back, because the earnings, the GDP is still good. The third quarter number is going to come out, I think, on Thursday. That's expected to be around 4%, close to, and the fourth quarter expectation is also around 4%. So that's a good GDP number. So the economy is fine. The labor market is fine still. The lag effects slowly are beginning to play into. So I think the recession timeline has been pushed out, so to speak. I think I'm in the camp that believes that maybe in the middle of next year we might have, and it'll be shallow because of given the resiliency of the US market. So net recession pushed out, maybe short and milder, and but right now things are still in good place. We don't want things to break at this point by wrong federal monetary policies and fiscal policies. So let's wait and see where that goes. At this point, cautionary is the operative word. Caution is the operative word.
Right. Mr. Rao, Bill Ackman said on Monday, he said that he has covered his bet against the long-term treasuries, as he believes that investors may soon seek safety in bonds as the geopolitical tensions mount. What are your thoughts on the situation?
Agree. Well, everyone's been wrong so far. We were supposed to have a recession beginning of the year, then it became middle of the year, then end of the year. Now it's beginning of next year. So nobody knows where that goes. Everyone's surprised at the resiliency of the market. But at this point, looks like the lag effects are going to play out. People are cutting back. You see the mortgage rates going up, so that's going to slow down the housing market and the whole ecosystem that works around the housing market. That's huge. So that's going to slow down. It's going to cost jobs. So all those things. So looking at all this thing, Bill Ackman, Bill Gross also, who was the bond king, they believe that the economy is going to get worse. So it's time to unwind the shorts and kind of get into the safe haven because the rates are going to go up. Yes, there's a good argument for that. There's good data to support that. But let's wait and see. I mean, they have been wrong before. I mean, he was pulling for, I think he was shorting the bond market. He thought my economy will come back, but now he's on the other side. So everybody's being confused with the market. I don't think any prediction has been right so far, only because of the changing variables. And then we have all these geopolitical issues playing into this thing. So let's see where that goes. I agree with what he's saying. There are a lot of people moving into that, into the bond market as a safe haven because it's safe. I'm sure it's going to be there for at least a year. So people are parking their money there rather than take the risk of the stock market, which is very uncertain at this point. So that makes sense, but let's wait and see where he is. I'm not totally in their camp, but I believe that they have a case that can be that the economy will get worse before it gets better.
Okay, but Mr. Rao, do you think that the markets have really brushed this whole geopolitical tension under the carpet? Are we really missing the woods for the trees? Does market need to be more cautious on that front?
Absolutely. I think that's a good question. And that's the core of the question now in everyone's mind. It hasn't spread. There are some good discussions going on and kind of how to bring this to an end. If it has a ripple effect across the board, if Russia, China, everyone gets involved, and then everything has an impact, cumulative impact. At this point, it doesn't. It looks very centered around one or two hotspots. So, and that's the hope and that's the belief. And most countries cannot afford to go to war at this point. They're all fighting their own battles. So they don't want this thing. So it's in their best interest to work this out. And I think that's the hope. And that's the camp I am in. I believe that something will be worked out. Israel, of course, has the right to defend itself, but hopefully there is a common ground that they reach on whether it's humanitarian or whatever, that they stop here and things are settled. But it hasn't spread. So market is aware of what's going on, but they think it's very localized at this point, and it's not going to spread. And we are used to Israel being attacked, and in the US, of course, it's a very common thing. But this one seems to be okay, even despite all the gruesome attacks and the bad situation there. I don't think it's spreading at this point in terms of the impact across the world. It's very localized.
All right, Mr. Rao, on that note, we'll let you go. Thank you so much for joining us today.
Thank you. Thanks for having me.